Welcome back to Metal Market News. This is Prevofa. Harry! And today we're breaking down one of the most misunderstood moves happening in the market right now. The drop in gold prices, which on the surface is being presented as a loss of confidence in gold as a safe haven. But when you actually step back and analyze the mechanics behind it, the narrative starts to fall apart very quickly. Because what we are witnessing is not a shift in long-term sentiment. It is a short-term liquidity event driven by stress building across multiple areas of the financial system. And this is exactly where seasoned analysts like Gerald Salento are cutting through the noise, pointing out that when markets begin to break, whether it's equities declining, leverage unwinding, or institutions facing margin calls, investors are forced into a position where survival becomes the priority. And in that moment, they don't sell what they want to sell. They sell what they can sell. And gold, being highly liquid and often sitting on profits, becomes a primary source of cash. So instead of interpreting the drop as weakness in gold, it should be understood as forced liquidation. Now, from my independent perspective, I agree with this core argument. But I would emphasize that this is not just a temporary phenomenon. It is a reflection of deeper structural fragility in the system. Because if liquidity pressure is strong enough to force selling in one of the most trusted safe haven assets, that tells you that the underlying stress is already significant. And this is where most retail participants misread the situation. They react to price instead of understanding cause. And in doing so, they end up aligning themselves with the wrong side of the trade. Because historically, these kinds of forced sell-offs often precede strong recoveries once the liquidity pressure eases. So the real question is not why gold is falling, but what that fall is signaling about the broader system. And right now, it is signaling stress and not rejection. And that distinction is critical if you want to navigate this environment with clarity rather than confusion. As we move deeper into the discussion, the next major narrative that needs to be challenged is the relationship between interest rates and gold. Because the mainstream explanation suggests that rising rates are inherently bearish for gold. But when you actually examine historical data, that relationship is far more complex and often misunderstood. And this is where Gerald Salento brings in the example of the late 1970s, a period where both inflation and interest rates were rising simultaneously, yet gold prices surged significantly. And the reason for that lies in the concept of real interest rates, not nominal rates. Because what truly matters is whether interest rates are keeping up with inflation, and if inflation is rising faster than rates, then in real terms, investors are still losing purchasing power by holding cash or bonds, which makes gold an attractive alternative. Now, when I compare this with my own analysis, I find strong alignment. But I would add that today's environment introduces additional complexity due to structural inflation drivers, such as energy prices and supply chain disruptions, which are not easily controlled through monetary policy. And this creates a situation where central banks may continue raising rates. But those increases may not be sufficient to generate positive real returns, meaning gold's long-term appeal remains intact. And unless we see an extreme scenario where rates are pushed to levels high enough to genuinely compete with gold, which is unlikely given the current economic fragility, the argument that rising rates will suppress gold loses its strength. So once again, what we are seeing is a disconnect between narrative and reality. And for investors who understand this dynamic, the current environment becomes less about fear and more about strategic positioning. Because when the majority is focused on simplified explanations, that is often where the biggest opportunities emerge. Now shifting the lens toward institutional behavior and government actions, another layer of pressure on gold becomes visible. And that is the role of large players during periods of economic stress. Because when governments face fiscal constraints, or when financial institutions are dealing with losses, they often turn to their most liquid assets to stabilize their positions, and that includes gold, which adds additional selling pressure that is not driven by sentiment, but by necessity. And this is a critical point because it reinforces the idea that current price movements are not reflective of a change in gold's fundamental value, but rather a response to immediate financial pressures. Now, from my perspective, this behavior is actually a warning sign, Because when entities that traditionally hold gold as a reserve asset begin to sell, it indicates that liquidity conditions are tighter than they appear. And this ties directly into the broader economic backdrop, where recession risks are increasing, employment prospects are weakening, and cracks in the system are becoming more visible. And yet, despite these signals, central banks continue to pursue tightening policies, which creates a highly contradictory environment. Because tightening into a slowing economy can amplify stress rather than alleviate it. And this is where the concept of dragflation becomes increasingly relevant. A scenario characterized by declining growth and persistent inflation, which is arguably more challenging than traditional stagflation, because it limits the effectiveness of policy responses. And in this context, precious metals like gold and silver continue to serve as important hedging instruments, even if their price movements appear volatile in the short term. Because their underlying role in preserving value does not change simply due to temporary market dynamics. Another critical factor that cannot be ignored is the role of geopolitical narratives and inconsistent policy messaging in shaping market behavior. Because what we are seeing increasingly is that markets are not just reacting to events, they are reacting to the way those events are communicated. And when political leaders issue strong statements, set aggressive deadlines, or escalate tensions, markets respond immediately, oil prices rise, equities come under pressure, and volatility increases. But when those same narratives shift suddenly, when deadlines are extended or tones are softened, the market reaction reverses. And this constant back and forth creates instability, not stability, because markets rely on consistency to function efficiently. And when that consistency is absent, confidence begins to erode. And from an analytical standpoint, this is extremely significant. Because financial systems are built on trust. And when that trust starts to weaken, the effects can ripple across all asset classes, increasing volatility and reducing predictability. Now, when I compare this observation with my own view, I would argue that this erosion of confidence is one of the most underappreciated risks in the current environment, because it not only affects short-term price movements, but also influences long-term investment decisions. And this is why we are seeing increasingly erratic behavior across markets, where assets move sharply in response to headlines rather than fundamentals. And in such an environment, it becomes even more important to focus on underlying dynamics rather than surface-level narratives, because those dynamics are what ultimately drive long-term outcomes as we bring everything together. The final and perhaps most important aspect to consider is the broader structural imbalance that continues to build beneath the surface. Because while daily headlines focus on price movements and short-term explanations, the deeper issues remain unresolved. Monetary policy is attempting to address symptoms without tackling the structural drivers of inflation, such as energy costs and supply constraints. And as a result, the underlying tension continues to grow. And historically, these kinds of imbalances tend to resolve in significant ways, whether through policy shifts, market corrections, or systemic disruptions. And in that context, assets like gold and silver play a unique role because they are not dependent on policy credibility or financial engineering, which makes them resilient over the long term, even if the path is volatile in the short term. Now, from my independent perspective, the key takeaway for investors is not to get caught up in short-term noise, but to understand the structural forces at play and position accordingly. Because when liquidity pressures force sell-offs in assets that are meant to provide stability, and when policy and geopolitical signals remain inconsistent, it raises a fundamental question about the sustainability of the current system. How long can markets continue to rely on confidence before that foundation begins to weaken further? And that is the question that should guide your thinking as we move forward, because the answer to that will determine the next major phase in the financial landscape. And if you remain focused on structure rather than noise, you will be far better equipped to navigate whatever comes next. This is Prasav, Harry, and you're watching Metal Market News, where we bring you independent, data-driven insights that go beyond the headlines and to the real mechanics of the market.